Hello and welcome to this second video that is looking at Unit 503 on the ISMM Professional Sales Qualification, and Unit 503 is all about sales forecasting. There is already a video available covering Learning Outcome 1.1, which you can go and see back in the ISMM archive on the website. This video is going to look at Learning Outcomes 1.1 through to 1.5, so the rest of Learning Outcome 1. The first one of these to cover is to have a look at Learning Outcome 1.2, which is about the data that we need to go and gather in order to start to be able to build a really good high quality forecast. It's really important to actually understand where this data can come from and draw quality data from a number of different sources in order to enable us to create a powerful forecast that is going to be useful for us. So let's have a look at the three key areas of data sources that we can look at relatively easily in most businesses. The first one, and the most straightforward, is to look at the company data that we have. What exists within our business that we can use? Now, it's predominantly going to be historical from a data point of view, but we can start to look at not just trends in our particular aspect of the business or one particular product, but we can start to look in trends across categories and across the business as a whole to see what is actually happening. If you're not collecting this data already, start now. There are some businesses that do this really well and have a wealth of historic data about the performance of the business. If you haven't got that, make sure you put a system in place to catch it, because it's really difficult to start to be able to predict the future and to forecast the future if you don't actually have good quality data from inside your organization to start with. The second area, which is a lot harder to get hold of, but can be got hold of even if there's cost involved in it, is to get market data. Now, some market data is openly published, and if you read trade magazines and so on, you'll get an idea of what's happening in growths in certain sectors and so on, but you can go out and buy market data. And again, the guys who are very sophisticated at forecasting will go to the big research houses and go and buy market data, so they can see what's happening to share over time and they can see what's happening to the overall market over time. Don't forget, with both company data and with market data, we're looking at value data and volume data as well. And for internal stuff, we can look at profitability trends and so on, so we can get really accurate in terms of our forecast and have one that broadly represents the way that the business is performing. The third area to look at is really broad, and this is where we start to look at social data, where we start to look at trends in society, where we're trying to predict what is happening. Now, that is incredibly difficult, but again, what we need to do is just read an awful lot around. That will enable us not to make an accurate prediction of what's going to happen in the future, but it may enable us to go and say, well, what if, and start to put some scenarios in place. Maybe even put things out into test market to see whether we've started to predict the future with a degree of accuracy. So have a look at company data, have a look at market data, and have a look at the social data that is available for your industry as well. What you do need to avoid, of course, is this idea of paralysis by analysis. There is a lot of data out there, and it's a bit like anything, particularly if you're researching it online. You can go deeper and deeper into things. You have got to decide when to stop. And the reality is the nth piece of data and the nth plus one piece of data is not going to make a massive difference to your forecast unless you've made some major errors in the first place. So what we need to do is make sure we get enough data in place to put a quality forecast in place, and just make sure that there's enough in there to be reasonably accurate. As we mentioned in Learning Outcome 1.1, nobody can accurately predict the future, and if we could, we wouldn't be doing the jobs that we are. So we need to accept the fact that it's going to be our best guess. A couple of things to bear in mind in addition to this idea of paralysis by analysis are inattentional blindness and cause and effect. Inattentional blindness is basically about being either over-optimistic or over-depressed, or basically looking and seeing to what the data is saying that will predict what we thought was going to happen anyway. There's a real temptation to look at anything and see what we want to see, and that is what inattentional blindness is all about. If we're very excited about our product market, it's quite easy to go and find data to support the idea that we had in the first place, and then build that into a forecast without challenging our initial assumptions. Likewise, if we're not feeling so good about our business, not feeling so good about our industry, there will be data available that will enable us to put a really negative forecast in place. but make sure that you take that into account when you're putting in there. Say, what assumptions and what presuppositions am I putting in place over and above what the data is actually saying? Go in honestly with it. The second one is when we've got all of this data and we start to link it together, make sure that we understand what is causing things and what is being affected by things, and actually where we get sets of data that seem to be very closely related to each other, are they really closely related to each other? As a question for you, what data would be related to the sales of ice cream in a market so closely that you actually think one would cause the other? Now, I would hope that if you sort of step back from the detail, particularly if you know a lot about the ice cream market, you say, well, obviously it's going to be weather. That would probably be the single most powerful driver of ice cream sales, with an element of seasonality within there as well, perhaps Christmas, for example. But actually, one of the biggest things that relates to it is you can actually find a very, very tight correlation between all sorts of things. And one of the things is the number of people dying being tangled in their bed sheets with the consumption of cheese in the US. Now, it's hard to argue that actually there is a cause and effect relationship between those two pieces of data, but actually they tie together extremely well. And you might be able to find somebody who would create a story that says, actually, these two are cause and effect. So as we get into data and as we delve further and further into detail, every now and again we do need to step back and do a sense check on what it is that we're talking about. The next thing we need to do is then look at the relationship between our forecast and what is actually happening. And that relationship and the differences between the two are known as variances. There are variances within any sort of forecast because we're not going to get it right 100% of the time. But it's important to look at those variances for a couple of reasons. One is it can help us to understand what went wrong with our forecast in the past. And the second is, by understanding what went wrong with our forecast in the past, we can then look into the future and say, okay, let's make sure we don't make those mistakes again. We can predict better for the future by understanding what we got wrong in the past. So the first thing that we need to look at is which variances are natural variances, because we can't predict perfectly, and which are things that were really significant that we should have been able to predict. So there is some fluctuation that will always happen in pretty much any market, and do you know what? There's not a lot we can do about that. We need to accept the fact that our forecasts are going to be slightly out from time to time. But for the things that are the big things, are they things that we could have or should have predicted, or are they genuinely unpredictable events, or were they unpredictable when they happened? So let's split those normal variations and those abnormal variations out. Let's think about what the normal variations would be. We might say, well, our forecast was out by £100,000 this quarter. Well, is that important or not? Well, I guess it kind of depends whether your quarterly sales are £200,000 or your quarterly sales are £10 million. We need to look at the difference in the relation to the size of the business that we're operating in. Because if we're operating a huge business, tiny little percentage fluctuations, 1%, 0.5%, things like that, then fine. Do you know what? We're just going to have to live with those things. If we're forecasting and we're out by 20, 30, 40, 50, 100%, we have an issue and we need to get better at our forecasts. So what are the common causes of the difference between what we forecast and what actually happens? The common causes of variances. Let's have a look at those, particularly these abnormal ones. The first thing is let's have a look at a set of data. Now initially, when you've got your actuals versus your forecast on this chart, it looks pretty good. It looks like whoever produced this forecast did a pretty good job of it. But one of the issues with this, and this is really easy to play around with in a spreadsheet program like Excel or something like that, is the scale on this side, because the scale is actually right the way from zero. And because of that, and because we're talking about relatively high numbers, that can hide some fairly significant differences. So let's have a little look if we change the scale on the left-hand side of the chart and see what it looks like then. Well, actually, what you can see is just over halfway through the year, there was a massive difference. It looks at about a sort of 50% difference now we've changed the scale. Obviously, it's not 50%, but we can see there was one month in particular where something stands out. And most of the times it was, within plus or minus 1% across the course of the year for a forecast. But one month in particular, there was a 5% gap between what we forecast and what actually happened. So we might need to look at what caused that. What was the issue behind that forecast? Was it something that we should have been able to predict? Or actually was it one of these really abnormal things that, we didn't stand a chance and we just have to live with it? The other thing, though, is to say, well, actually, was it just a month? Let's look at it in a different way. The same set of data looked at on a quarterly basis actually looks pretty reasonable. Because what you're looking at here is each quarter, you've got quarter 1, quarter 2, quarter 4, all showing the same sort of relationship. We're slightly behind forecast. And in quarter 3, we're slightly ahead of forecast. All of those differences don't look particularly extreme, so you say, do you know what, we might have been bad one particular month, but some sort of spike happened and it was evened out by what happened at the month either side of that, so let's not worry about it too much. It's useful to do these checks to see what analysis we do need to do and to stop over-analysing things that just aren't very important. What we can actually see when we look at the quarterly one is that the actual data, the green data on the chart, with the exception of one particular quarter, is pretty flat. We had one exceptional quarter, the second one in, which we didn't manage to forecast. All we forecast was nice smooth growth going across the 4 quarters, when actually what happened is quarters 1, 3 and 4 were flat. So by doing this, we say, well, okay, we've got a couple of issues that we need to investigate in terms of understanding the variances in our business. What happened specifically in quarter 2 that made sales rocket way ahead of where we were predicting it would be? And secondly, why did we go ahead and forecast steady growth across the course of the year when actually, with the exception of one quarter, we're in a flat business? So these sort of things, just playing with the data, changing scales on charts, changing time frames over which we reference it, very quickly can start to focus our mind on investigating the bits that we really do need to go and investigate. So the factors that drive this fall into 3 categories. We have internal, narrow external and broad external stuff. Internal things are things that happen in the business, and you can really strongly argue that we should understand the things that are happening in our business. It could be that the data that we had to put into the forecast was poor. It could be that communication across the business in terms of what was happening on different product lines or from a promotional point of view wasn't fully integrated into the forecast. And those sort of things do need to be ironed out and can be ironed out relatively easily. As we move into narrow external, it becomes slightly more difficult to do. But narrow external is saying, what are the immediate changes in the environment in which we operate that has made us miss our forecast one way or another? So that could be essentially customers or your competitors. What are they doing that is causing fluctuations in your sales rate? It then gets increasingly hard as we move right over to the far side and we're looking at the broad external stuff, because the broad external stuff are these big sort of societal changes that are changing the performance of your business. So it may be one of those. It's quite easy though to blame the broad stuff, because then we can shrug our shoulders and say, do you know what, it wasn't our fault that we got the forecast wrong. Make sure that you look at the internal stuff and the narrow external stuff first, because actually the majority of forecasting errors tend to fall into those 2 categories, because the broad external stuff changes very, very slowly over time. As we move into our learning outcome at 1.4, here is what we're looking at. Why should we bother? What is important about forecasting? Why should we put all of this effort into creating the forecast in the first place and then managing and measuring variations versus the forecast on an ongoing basis? Why bother? We're salespeople. We shouldn't have to do all of this maths. Well, the reality is it is really, really important. If we fail to forecast, there are going to be some very significant business issues that will be faced by you in your business, and even more importantly, and causing a lot of the issues in your business, faced by your customers. So the first thing is, it's going to stop us being successful at shifting our products and services and maximizing our sales. Let's say that we consistently under-forecast what we're going to do. It's a temptation that salespeople fall into, because then you can come and say, hey, we've smashed our forecast, we've beaten our targets again and again and again, and feel really good about it in the short term. But the problem is, if any business has got any sort of lead time in creating those products and services, you won't be staffed up. You won't have the stock in place to be able to fulfill your customers' demands if you do that on an ongoing basis. And if you can't meet your customers' demands, guess what? They're going to go somewhere else to do it. This is particularly live at the moment if you're reading anything about the shipping industry, for example. There are retailers already worrying about what's happening in Christmas because there are big transport ships being stuck outside docks because businesses have gone bankrupt, they can't come in and offload their product. And because of that, they're struggling to make sure there's going to be enough stock for Christmas. I was reading a couple of days ago that actually there is a ship with a load of Samsung white goods currently stuck off the coast of America, unable to go into dock to unload. And because of that, they've forecast the sales, they're not going to be able to deliver it. So all sorts of things like that can happen. And if we do that on a consistent basis by under-forecasting and not preparing ourselves for the lead time for delivery of items or production of items, then do you know what? We're going to disappoint our customers, we will lose sales. The second big risk is actually, if we want to build good, strong relationships with our customers and with our clients, we need to forecast well. Because they will get upset, they will go somewhere else, they will start to trade around the market and that sort of thing, unless we can produce a reliable supply chain for them. And one of the great things is this is a really good route in terms of building a great relationship with customers, because if we go in and we talk to them about the complexities of forecasting, get their help with forecasting, it becomes a joint exercise where we collaborate with our customers as opposed to keeping everything separate. So go in and work with your customers on it because it will improve your forecast and then improve your delivery through to your customers. Fundamentally, forecasting well is about delivering revenue and profits for your organization by satisfying your customers and also by minimizing the supply chain impact of having to either turn volume on very quickly, which is usually expensive. You might have to hire in temporary labor if you're in a production environment, for example, or carrying far too much stock and having far too much overhead in the business because your forecast is constantly over-optimistic. So we need to be aware of both of those sort of things in order to successfully manage a stable and robust business. And then the final element of Learning Outcome 1 is 1.5. It's the idea behind what is a challenging forecast, what is a realistic forecast, and what should a forecast actually be there to do. One of the most important things is to distinguish quite clearly between what is a target and what is a forecast. A forecast is our best prediction of what will happen in the future. It is not about being over-optimistic and saying, do you know what, let's shoot for the stars and all of that sort of stuff. There's a role for that, but it's a role for a different sort of measure. And it's also not about consistently underplaying your forecast so you look good. You might want to do that with your targets. It's not something I would recommend, but it is not something for the forecast. The forecast has to be deep, scientific, and robust because it is about managing the business successfully. So I'll give you a couple of examples of that. This difference between the forecast and target is to say, do you know what, I've got a target to triple sales in 5 years and all of that sort of stuff, but I need to be realistic about it. If I've got that forecast as a tripling of sales, then I need to be staffing up. I need to be increasing my stock levels. I need to be increasing my production capacity. Am I really going to invest that money in something that is a dream or a hope? There's nothing wrong with having the dream and the hope in place, but do you know what? Don't build it into your forecast. Make sure your forecast is absolutely robust. Review it on a regular basis, because if you've got that target and you're really driving for it, you may get there, and you may get there more quickly than you think you are. But use your forecast as a revision process as the year goes by when you get evidence that you're actually delivering that. Don't just do it as a pipe dream into the future. One of the elements around target setting, and I agree with this, is aim for the sky and you'll reach the ceiling, aim for the ceiling and you'll stay on the floor by Bill Shankly. That's true, but that is for aims. That is for targets. That's for dreams and aspirations. Here we're talking about the science of forecasting and it doesn't really apply. What we need to do is make sure that we understand the difference between those two and get realistic. So I will end this section by a quote from Procter & Gamble, from Bob McDonald, who was a chief operating officer a few years ago at P&G. And this is what he said. He said, goals are really, really important because what they do is they clarify the way that the business is going to operate in the future. What we need to do is make sure that we have a really robust process to make sure that our forecasts are accurate so that we can run the business in a smooth and successful fashion, making sure that our customers are happy with what we deliver to them and that we minimize costs in the organization. So thank you very much for listening to that. I hope you found it useful. We will come back to the ISMM Unit 503 over the next few weeks, and we're going to look at the Learning Outcomes 2 and beyond. That wraps up Learning Outcome 1. As usual, please do get in touch if you've got any questions or if you want any further explanation on anything. Thank you.